But should investors be concerned about those shrinking profit margins Bob was just describing? Let's bring in Art Hogan. He's National Securities Chief Market Strategist. Art, it's great to have you here for sort of a throwdown on earnings per share, where people are expecting they're going to be revised lower. They say that's the only reason some of these forward multiples for the home builders or even for the market make sense. Why are you still pretty constructive?
Yeah, it seems to be the new conversation around the street. And the narrative is, if we feel so badly in the here and now, how can earnings estimates not have come down yet? And I think the answer to that, quite simply, is probably threefold. First and foremost, emotionally, we feel bad because we're paying so much for food and energy product. And yet corporate America has been able to pass along a lot of those costs. So if we go through the first quarter earnings reporting season and see what happened exiting that, we saw estimates for the second quarter and second half actually go higher. And that's in a world where you and I know well that analysts on Wall Street tend to be very conservative, and that's why we tend to see 65 or 70% of companies beat their estimates every quarter. And I think that right now we're just trying to attach how we're feeling in the here and now versus what we would like to ascribe to earnings growth in the second half of this year. And a lot of that may not come to fruition. I think one of the things you forget is part of the issue is inflation, and obviously that's going to inflate sales. And if margins remain not at record levels, but at something of more historic norms, right, I certainly think the earnings season is going to be fine. We'll know a lot more about this in the second week of July when earnings season kicks off in earnest.
Well, it's one of those times when you remember that we are in a nominal GDP boom and a real GDP recession. So anything priced off nominal is going to do well. But the problem is expenses are priced that way, too. I don't know if you can kind of look through and talk about the places where you think it might. I mean, it was a surprise even for the financials back in the first quarter with JP Morgan and everybody when people said, wait a minute, these profit margins are nowhere near what we thought they were going to be. So could we be in for some nasty surprises still, even with strong top line growth?
Oh, sure. And I think that, JP Morgan's a great example of that. When yesterday they had the ability to increase their dividend, increase their buyback, et cetera. And what they're really going through is some of that overbuild in departments where they likely, got ahead of themselves. And the mortgage department, the mortgage underwriting department is clearly one of those. So there's going to be some adjustments that corporate America has to make. We're going to see a lot of that, especially when you overbuilt for what the environment was last year. And the environment is different this year. But I think on balance, when you look at the entirety of the S&P 500, we're clearly likely to see earnings that are above estimates for the second quarter and second half, unless something draconian changes. Now, the real question is, what multiple should you ascribe to those earnings in a slowing economy with an interest rate that's likely to be closer to 3.5%,
right,
U.S. 10-year at the end of the year versus what you would have last year when the yield on the 10-year was 50 basis points?
Well, and that brings up, there's two very, should we say, controversial points that you have here. I mean, one is that earnings will be revised higher, and the second is that, am I right that you think the multiple on the S&P should be 19 times?
Yeah, I think that, but that's a trailing 12, right? So when we exit the year at a trailing 12 multiple, 19 times would be the lowest we've seen over the last 10 years. That's not a forward multiple. So yeah, I think the forward multiple on 23 will likely be closer to 16 or 17.
Got it.
But looking at 22, that's a year-end target, so you have to look back at what the multiple is on last year's earnings.
Right. So, okay, so 16 or 17 times, which is kind of where we are now, maybe a little bit of expansion. But it sounds like then you think this adjustment is done. I mean, our guest just a moment ago was saying he thinks people should be buying fixed income because rates have kind of put in the highs for the year. Is that consistent with your worldview as well?
Well, I would tell you this: if consensus is that the Fed funds rate exit this year, call it 3.25 to 3.5, which is where consensus is now. That was a week ago. That was 3.5 to 3.75. So that's backed off a bit. The 10-year likely is going to track somewhere around that, and historically that'll be the case. So, at least for this year, know that that sort of 3.5 level is probably where we peak out for a bit, and we'll bounce in between 3.25, 3.5 for most of the second quarter and into the third quarter. But yeah, that's what we would say. And if you want to ascribe what historically has been the right multiple to that, you sort of just, get to 17 pretty quickly.
All right. So stock pick wise, that's kind of also where the rubber meets the road. You got a couple of tech names in here. Apple, I doubt you would change it based on this this tweet about Qualcomm's modem chips. No. But yeah, no. Apple, Microsoft, even AutoZone kind of pops up on your list. Why these three?
Yeah, all defensible. And when you think about all three of them, you've got defensible cash flows in both Apple and Microsoft, very strong management teams, great balance sheets. And what has become less and less a discretionary spend for people is both software and the suite that Microsoft offers. If they're able to make this acquisition that they're working on now, I think we'll look forward to be accretive immediately, and just a real defensible cash flow. So it's very much of a defensive growth name. I feel Apple falls in that same category, with very shareholder friendly management team that buys back shares and has a steady dividend. AutoZone's a different story. It's again not a discretionary item. If you need a new you need a new alternator in your car to drive the kids to school, you're going to get it. You're not making that decision. And the fleet age has continued to get older and older because people just can't access new cars. So the older the fleet age, the more the AutoZones and O'Reillys and Genuine Auto Parts, et cetera, are going to be in demand. And AutoZone is a company that's bought back its shares consistently. So I think the multiple is very attractive there as well.